Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Good to be back, Bills. Good to be back for another podcast.
Andrew. It's always good to be in here recording with you. Last episode for the last podcast?
Yeah.
For the year.
Last one for the year. Time's really flown by and we're already at the end of the year and already staring down the barrel of all the festivities and craziness that's transpiring.
We've made it indeed, and looking forward to a little bit of time off. Hopefully everyone gets the opportunity to spend some time with family and friends, so that'll be nice.
Yeah, absolutely. Absolutely. Are you away or doing anything special this year, Bills?
A couple of weeks off, just some downtime. I mean, life's been pretty crazy in Melbourne, so just the opportunity to kick the feet up and not really think about anything, and hopefully with a lot of freedom, to be honest with you. So not much, and fingers crossed for some good weather. What about yourself?
Yeah, likewise. Just a couple of weeks off. So we're shutting down the business for a little bit. And then away in between sort of the Christmas and New Year, we're away just down at the coast with some friends. So should be good and looking forward to it. And hopefully while we're down there, the weather turns it up a little bit. Hasn't been particularly pleasant of a spring over here in Melbourne.
We'll wait and see what Melbourne does. Hopefully Melbourne's not at its finest and doesn't keep us on our toes with the 4 seasons in one day. But yeah, hopefully we get a bit of a summer and everybody can enjoy it and enjoy a bit of time with family and friends over the festive season.
Yeah, exactly. Before we get to that, we've got some technical stuff to run through and a bit more of, technical podcast this time around, don't we, Bill?
Well, that's it. This podcast, we're talking back onto the investment theme, a little run on property, which we thought was quite fitting considering what we're seeing, in Melbourne and I guess right across the country. But back on the investing theme, and we thought it'd be fitting to talk about sort of the two main investment styles that we come across. And that's an active investment style versus a passive or an index investment style. And that's what we're going to riff about today. And yeah, hopefully we do it some justice like usual and give some information to our listeners and create some value for them.
Yeah, absolutely. Absolutely. And a very topical look, it's something that people talk about all the time. And it's something that sometimes gets people pretty excited and passionate about, whether you go down the route of an active fund or whether you go down the route of an index fund, and what's better and what should you be doing and how do you structure it. But I mean, sort of taking things back a little bit, what is it? What's an active fund, Bills? What's an index fund? How do they differ from each other? What are we even talking about here? Let's take it a step backwards and sort of go to the definitions first before we run into it.
Go backwards to go forwards. I like your thinking. We might just take it a step up a little bit or a step back. You're absolutely right. And we'll talk about an asset class because that's probably the easiest way to think about an investment style. Each individual asset that you can invest in sits within an asset class. So if you think about something as simple as property, we were talking about property last time. So property sits in its own asset class, shares sit in their own asset class, infrastructure sits in its own asset class, and so on and so forth. With an active investment style, you have a particular investment manager or investment philosophy that is trying to beat that respective asset class en masse. So for argument's sake, and that's probably a good conduit and lead into what an indexed fund is. An indexed fund is just designed to track and perform at the same level as kind of the aggregate of that asset class, where an active fund manager is designed to outperform that index, so to speak, in that respective asset class.
So if an active fund manager is there to overperform what the index fund is, why the hell would anyone go down the route of an active fund manager, Bills?
Well, that's the idea between sort of what they're aiming for and what they're trying to achieve. Just because they're aiming for it doesn't necessarily mean that they're going to get it all of the time. I guess sort of going to the root of the investment philosophy that sits behind it. And the reason why I think indexed is also referred to as passive is because you don't really need to think about it too much after you've made that investment, because you're going to get the aggregate return for that asset class or that index that you're following or you're investing in. It's pretty straightforward. If a company sits inside that index and that company does really well, they're going to have a greater weighting in that index. So that's going to push the index up. If you've got a company that's not performing, they're going to fall outside of that index. So you don't necessarily have to be specific with the companies or the assets that you're investing in, because by its very nature of getting into that index, it's going to be a larger scale company and it's going to be represented in there. Whereas from an active perspective, the investment philosophy is that you're trying to pick the company that's going to outperform that. So if they're doing really well and you've backed them, fantastic, you're on a winner. If it goes the other way, then obviously you're in trouble because it's doing worse than its peers or doing worse than the index.
Yeah. So basically, an active fund manager is trying to achieve a rate of return above and beyond what an index fund manager is. And the underpinning of going down the route of an active fund manager is that you're to overachieve and exceed market rates of return. But by its very nature, what someone strives to do and what someone actually achieves is very different in reality. And if you look historically at some of the differences between an active fund manager and an index fund manager, the majority of the times, an index fund manager will overperform an active. But that also doesn't mean that you always go down the route of an index fund manager or a passive investment philosophy. You look at, for instance, and sort of one of the ironic examples of it is probably the greatest, if not one of the greatest investors of all time, Warren Buffett. You ask or you sort of listen to any of his talks or listen to him speak, and he's always saying, if you've got an amount of money and you want to grow your wealth, what's the best thing to do? Put it in an index fund manager and forget about it. But if you look at what he does with and sort of how he's built his name, he's an active fund manager by its very nature. How do you have an active fund manager that's overperforming quite consistently the market and recommends to people to invest in an index fund? It's one of those things that it's a difficult question to answer. And so hopefully we can, decipher it a little bit and provide some more clarity around the complexities with it today.
There's a very good reason for it. I mean, this guy is ridiculously intelligent, but I've got a big smile on my face because no matter what, whenever you talk about investing and stuff, and even if you're not in the world, I mean, everybody's heard of Warren Buffett and the quotes that he pulls out and all this sort of stuff. And it always brings a smile to my face when we think about this guy and sort of what he's achieved as well too. But from his perspective, obviously he took an active approach. His investment style was different.
And you could say that being a good choice was a bit of an understatement. He's done very well in that space, but yeah.
Absolutely. But I guess where he's sort of leaning into, and he's a very big advocate of like the Standard & Poor's 500 index is the way to go in terms of what he tells people to do. But it's more so along the lines of the index investing, and I need to be mindful of my words here, but for the average person that's trying to grow their wealth, that doesn't necessarily want to be consumed by this, that doesn't necessarily want to increase their knowledge and study up on this topic and be involved and look at it every day, the theory that I think he was trying to get to was invest in an indexed fund, assuming that the economy continues to grow. If you look at GDP and it continues to grow a couple of percentage points every year, over time, companies will get bigger and the index that you're tracking will get bigger and bigger, and therefore your returns will also increase and allow that compounding effect to happen. Essentially, you can just keep investing into it and not necessarily need to think about it. Which are the companies, the best performing companies that I'm investing in? You don't need to think about that because the index will take care of it. If the company gets too big for the index, the weighting in that index will reduce a bit. If the company no longer performs and is worth less, it'll drop out of that index. So you're not making those decisions as an investor. From an index versus an active perspective, the indexing makes it a hell of a lot easier to invest because you don't have to think about it. And investing is never set and forget, but you can just essentially keep contributing money to it, sort of dollar cost average into that investment over time. And if the economy continues to grow, which, that's the intent of an economy, then you should be fine with an indexed fund.
I think what it's also trying to avoid as well is that stock picking that sometimes people do when the friend told me at a barbecue that this is a great company to invest in, or this is a great investment to invest in, and put your life savings on one company, and it doesn't happen and it doesn't go the way that you were told because of Chinese whispers and someone told someone who told someone who told someone. It avoids that. It kind of makes sure that you're staying on track, investing in the largest companies and the largest investments without taking those fairly substantial gambles in order to make a large rate of return, but really means that you're diversifying in all instances, which I guess is a good sort of segue. It's also about cost as well, like an active fund manager versus an index fund manager. What's the difference in cost, Bills?
Well, that's a really good point, but just by their very nature, if you're investing in an index, there's a lot, and I don't want to downplay this, but there's a lot less work involved than if you're investing in an active fund. So from a cost perspective, you don't have as many investment managers, you're not buying and selling, you're not trading positions as much, you're not turning over the portfolio. And because you're doing less, that is reflected in the cost of the fund itself. So we look at some index funds and they cost around 0.20 basis points. Whereas if you look at some active funds, you're talking about, 1.5 percentage points. So it can be quite significant, but it's just the very nature of what the investment managers are doing, because they're not doing as much, because it's essentially just tracking a particular index. The cost of those things can come right down. And from an investor's perspective, one of the things, if you're talking about 100 basis points, so 1% difference between the price, that's 1% less rate of return that you need to achieve in order for these things at the end of the day or the reporting period that you're looking at to be equal in terms of your rate of return. Because you have to take this, or when you look at a return, you have to look at it from an after fees perspective.
Yeah. At the end of the day, a lower cost is going to mean that you don't need to achieve such a high rate of return or lower rate of return in order to get the same, if not a better return off the end of it. The other thing that can form a part of the consideration or a part of the decision-making process is that from a tax perspective, an index fund manager is buying, as you sort of mentioned before, an S&P 500 is buying 500 companies, and the top 500 companies, they're not actively trading as much. They're still, buying and selling investments as the valuation of these companies move. But you compare that to an active fund manager that's trying to overperform the market, they're changing positions quite frequently, which also means that from a tax perspective, there's usually a greater amount of capital gains that'll get realized in an active fund manager, whereas an index fund manager will not be doing as much trading, which in turn is reducing the cost, and at the same time is also not incurring or not realizing that capital gain or loss. But ideally, you're doing it for a gain. So from a tax perspective, it can also mean that an index fund manager is not incurring as much of a capital gain.
Yeah, no, well said, well summarized, Andrew. Talk to us about a little bit more about diversification with this particular approach when we're looking at index versus active.
Yes. So when you're looking at an index fund manager, especially if you're looking at, I think before we sort of go into it, it's important to note not all indexes are the same. It becomes really, really easy, especially, active, most people realize if you're buying and selling and you're looking at a fund manager that's has a niche or an area that they're looking at, then you can pretty easily recognize that the most active fund managers are different from each other because they've got a different approach, a different philosophy, and a different thing they're trying to achieve. But an index fund manager, a lot of people kind of think you just buy an index. But there's so many different indexes.
Take your pick.
Yeah. What are you investing in? Are you investing in the mining index? Are you investing in just the market index? Are you investing in technology index? Are you investing in an ethical index, Australian share, a property, an international share? There's so many different indexes that not all index fund managers are the same. And so it becomes pretty easy scenario to kind of paint them all with the same brush, but it's important to decide on what index you're actually investing in.
And then just to make it a bit more complicated, there's actually diversified index funds out there as well too.
Yeah.
The idea is you invest in one thing and that takes care of a whole range of different things.
Correct. So there's a huge world in either side of this coin. And there's some funds that'll do a combination of both. They'll do a combination of index and active. And so you can have a fund that does both. You can build your own portfolio that does a combination of both index and active. But sort of coming back to your question, An index fund manager, generally speaking, will hold more investment positions because they're trying to cover a broad market than what an active fund manager does. So an index fund will have a greater level of diversification, which if you use investment theory, that should reduce the volatility over time and should mean that it's not, as volatile because of the fact that you're exposed to a number of different positions. Whereas an active fund manager is usually a lot more targeted in their approach and usually has a great or a lower amount of investment positions, meaning that it is less diversified. Now, that doesn't always mean that it's a bad thing. Just because it's less diversified doesn't mean that you don't go into that position, because in some instances, you really need to take into account market circumstances. If you're investing in an index, you've got exposure to a large amount of companies, but if your belief and you can recognize that there's a certain market and a certain position that you want to get into and have exposure to that niche because there's great growth opportunity, then there may be an active fund that takes that approach and has that ability to take up that position in order to be able to make some great growth out of it.
Well, that's a really interesting point. I guess from a rising market, you're finding that an indexed fund, so the rising tide lifts all ships. So from that perspective, you'd expect that the index will continue to increase. And even from an active perspective, you'll also capture that as well too. Think about the rebound that we saw when investment markets got sold off in March of 2020, out of the back of the coronavirus being a greater reality than what everybody thought at the start, at least initially. But one of the things that I tend to find quite interesting is in a downward market, and this gives me a bit of comfort around the active piece. In an index market, you're on the ship, you're on the train, you can't change the direction. It's only going the one way of whatever the market's doing. There's nothing that you can do about it. You can't take a different position unless you exit from that investment option, obviously, but you're along for the ride. And that's the same whether the market's going up, market's going down, or the market's going sideways. That's just the reality of the nature of investments. And once again, we offset some of that risk by dollar cost averaging, and that's another way to manage that and play that. One of the things that I like from an active perspective is if they're in a position or if they're in a market where circumstances aren't favorable, the actual investment manager who's investing that money has the mandate to be able to change their position. So for argument's sake, if something adverse happens to a particular industry that they're invested in or a particular company, they can sell out of that position if they want to. They're not along for the ride per se. So they have a lot more discretion around that, which also comes back to the price and the cost that we were talking about. But that gives me a fair bit of comfort around what some of the flexibility is in an active fund manager versus an index fund manager. And in saying that, all of this stuff happens in the background. I mean, we're not involved in those as investors. We're not involved in those decisions. As financial planners, we're not involved in those decisions either. It happens in the background, and you're paying professional manager and professional investment manager management fees in order to make these decisions on not only your behalf, but on a pool of investors that are invested in that asset. So that's one of the things that gives me comfort from an active perspective, is in those situations, it can work in your favor from that perspective.
Yeah. And even in a rising market, there's also the fact that when you're considering an index fund, don't want to name any names because I'm just sort of utilizing it as an example, but you think about big bank A versus big bank B. An index fund is going to buy an equal share in each of those banks. Now, whether big bank A is better fundamentally in terms of their share price versus their relative value, or whether big bank B is better, an index fund manager is not even going to take that into consideration. They're just going to buy equal portions of each. Whereas you consider an active fund manager, what they're doing is looking at, all right, is now a better time to buy big bank B, or is it a better time to buy big bank A? What's their asset price versus their relative value? What's the future position in terms of the companies and their growth prospects? What are their financials like? So an active fund manager is going to have a much more targeted approach in relation to what they're actually investing in, as opposed to an index that's ultimately not really thinking about the specific companies, but rather just buying the largest companies within that asset sector.
Well explained, Andrew. Well explained. What about particular strategy? Because I guess in most instances, I guess the majority of people that we talk to sort of lean one way or the next. I mean, there's a lot of literature out there in terms of, is active better than passive? You can read all of this stuff till the cows come home. There's always stats and numbers around there about different fund managers' performance year on year, because it is difficult to stay right and get it right and beat the market year in, year out, regardless of what asset class that you're investing in. So there's always literature around what this looks like. And from our perspective, talking to people, they either tend to lean one way or another. But one of the things that we talk to some people about, and depending on your investment goals, your investment approach, your investment philosophy, we can have the best of both worlds with a core satellite approach. That way, we kind of satisfy both of those itches and we have a foot in each of those camps. Andrew, you want to talk us through what that approach is?
Yeah, so that's the approach of buying an index fund and pretty much having exposure to the market as an index, and then also buying on top of that an active fund manager in that same index or in that same asset class. So what that gives you, well, what that ultimately provides the benefit of is you're riding that wave with the quote that you used before of a rising tide moves all ships. You're having that index approach in terms of the broader market. But then on top of that, you're taking on a little bit of additional, I don't want to say risk, but a little bit of additional growth in an active fund where you've got exposure to an asset that's actively trying to overperform that index as well. So you're kind of keeping a foot in both doors and having the ability to kind of reduce the costs through the index fund manager, have the opportunity for some overperformance in an active fund manager, and really be able to take advantage of both worlds in essence, as opposed to just deciding on one versus another, which ultimately, look, personally, I don't think that really that's the right approach for anything, really, that it's one versus another. It's exactly the same as, when people talk about shares versus property or infrastructure versus property, or there isn't a right approach that you can use as a blanket statement for absolutely everything. You need to make sure that you're adjusting your position over time. You need to make sure that you're constantly reviewing your investment decisions over time. And you need to make sure that you're doing it in the right market circumstance, personal circumstance, and taking everything into account, as opposed to just using a broad brush statement of one thing is better than another, which I just don't think is the right approach.
I guess like anything, Andrew, this stuff is complicated. It can be really, really simple with just plain index and away you go. You move away from that and it starts to get very, very complicated. So like always, we're really big advocates of leaning into and getting advice and, getting someone to assist with this. If you're looking at a wealth creation strategy, putting a well-rounded investment strategy with some really strong investment principles that sit behind that, that's definitely the way to go with all types of investments as well, because it's really easy to get it wrong because of the nature and complexity and the variety of everything that's available. And we spoke about a few of those things today.
Absolutely. Wrapping it up and sort of tying the bow on it, a metaphor not only for the podcast that we're finalizing now, but also for the end of the year and sort of wrapping everything up. Active versus index funds. There are some differences between them. There are some intricacies. There are benefits of each camp. You can take advantage of some or both of those benefits, but ultimately it comes down to market circumstance, your personal circumstance, and making sure that you're receiving good quality advice off the back end of it. And from myself personally, and I'm sure Billy shares the same sentiments as well, it's a bit of a challenging year for everyone. And it's been a real pleasure to be able to really start the 360 Money Matters podcast. It's been a pleasure to run through it with you, Billy, and explore the world of podcasting outside of the day-to-day financial planning, the work that we do. So thank you all very much for listening. Really appreciate the feedback that we're getting as well, and has been a great pleasure to do so.
Andrew, thank you also. Always a pleasure being in here with you. And once again, we've been talking about this podcast for such a long time, and actually bringing it to fruition and getting it into the ears of our listeners is great. And it's always a bit of fun. We get a chance to talk a little bit more to a broader audience about our craft. So thank you. And to our listeners, look, massive thank you. We're getting some great feedback right across the the board. So keep that up. That keeps us going. Send your questions in. Really appreciative of all of the feedback that we're getting. And just signing off for the year. Happy holidays to everybody. Enjoy the festive season, time with family and friends. Fingers crossed we get some good weather and enjoy your time over the festive season.
Yes, enjoy the break, the well-deserved rest, and look forward to hitting it again in 2022.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorised representatives and credit representatives of AMP Financial Planning.